Hello, this is Doug Gerlach, the editor-in-chief of the Small Cap Informer stock newsletter, and today is our year-end subscribers exclusive webinar. We're going to wrap up the year and talk about the state of the market, especially with respect to small company stocks, and we'll have plenty of time to answer your questions. So before we begin, let me review our housekeeping for those of you who may be new to the webinar format. If you're unable to hear anything, please make sure that your system is set up correctly, that your speakers or headphones are plugged in, the volume is turned up, and you can use the GoToWebinar sound settings wizard to resolve problems. If the graphics or audio drop in and out during the presentation, I suggest that you turn off any unnecessary programs that might be running on your computer and don't connect to internet using Wi-Fi. And you can always listen using the telephone if you continue to have problems, and that will free up your computer to deliver the graphics portion of the program. At any point, you can reach out to gotowebinar.com for toll-free support. Check the email for their contact information or go directly to their website. The questions box is there if you have questions or comments along the way, so feel free to use that to enter your questions, and I'll do my best to monitor them and respond to as many of them as I can. You can also find the handout in the Handouts tab, so you may need to expand that Handouts tab in order to find the handout, but the handout is there. Maybe you need to refresh it if you don't see it. Hopefully the PDF is available to you and you can download that, print it, save it for later, and we will make it available after the webinar on the SmallCap Informer website, so you can get a copy then if you need it. So for those of you who are not familiar with me, I am the president of iClub Central, which is a for-profit subsidiary of the nonprofit Better Investing Organization, and I'm the founder and editor-in-chief of the Small Cap Performer newsletter, which is why you're all here today. I also am the editor-in-chief of the Investor Advisory Service stock newsletter, which is a 9-time recipient of the Holbert Newsletter Honor Roll, and I oversee our product line of tools for investment clubs and individual investors that are produced by iClub Central. I've written 6 financial books, including The Complete Idiot's Guide to Online Investing, Investment Clubs for Dummies, and The Armchair Millionaire, and I frequently am on the road traveling to Better Investing chapter events, the AA conferences and chapter events, and events like the Money Show, where it's my passion to help investors become better at picking stocks and managing their portfolio. Tonight, let's start out and talk about the performance of small caps in 2018 and looking back in time. Of course, it's been a tough year for the market. Here is the year-to-date performance of small versus large cap stocks as well as international stocks through the first week of December. The green line at the top is the Russell 2000 small cap index, and it's down about 7% year-to-date as of the end of last week. The S&P 500 is not having a good year as well, down 3.5%, although it's come back a little bit in this week's trading. The Morgan Stanley EAFE index, that's the Europe, Australasia, Far East index, is down 15.4%. It had a banner year last year, but this year the international large cap stocks in developing countries that are represented by the EAFE have struggled, and we've seen that decline. This speaks to the importance of diversification if you're interested in managing a diversified portfolio, for instance, for your 401k. These 3 market segments, I think, are really terrific because they don't always perform in sync. Some will perform better than others at any point during the global economic and market cycles. So the Russell had reached an all-time high in late August, so it's down about 15% or more since that point. So that's really pushing small cap valuations into a very much lower range. And as we expect from small company stocks, that additional volatility that we don't see in the broader markets. But again, if we look over the long term, you can see here small cap stocks remain the best opportunity for the highest total return over the long term. And you can see that this graph going back 15 years shows a significant outperformance of small company stocks compared to large cap stocks. And you can really see, again, perhaps a little bit of additional volatility apparent on this chart. The Russell tends to bob up and down a lot more than the S&P 500. But over the long term, we hope to capture that outperformance of small company stocks, which is why I think it's so important that investors maintain good exposure to smaller stocks if you're looking for a total return growth portfolio. The Russell 2000's current PE ratio is about 17.8, 17.9. The Russell 2000 PE ratio in April 2017 was 25.5, so it's 30% lower than it was about 18 or 20 months ago. So that's pretty significant. You'll see a note here, the PE is X negative earnings on a trailing 12-month basis. So that's the way that Russell calculates and displays the PE ratio of the index by not counting any companies with negative earnings. Sometimes that actually pushes the PE of the Russell 2000 into negative territory. That's not something we see with the S&P 500 to have a negative PE of the index, but small company stocks exhibit a lot more volatility. By comparison, right now, if you include companies with negative earnings, the PE of the Russell 2000 is over 61. And if you compare the current PE of 17.87 to the S&P 500's 21.78, you can see that the small company stocks have really been beaten down and now are priced on a value basis more attractively than large company stocks. I think that's a very favorable valuation for many companies, and we'll certainly talk about that as we go through our presentation today. If we look at the companies that we track in the small cap informer, there are, I believe there are just about 50, there may be 49 companies that we cover right now. The average PE ratio on a trailing 12-month basis is 18.9, so a little bit higher than the average of the Russell 2000. I think that just points to our focus on quality companies as opposed to the Russell's managed index of companies that includes representation from all industries, all sectors, and so they end up with a mishmash of both high quality and low quality businesses, where we focus really on trying to identify companies that are exceptionally well managed. The average growth rate of the companies on a weighted average basis is 14.3%, and the average projected total return of the entire set of companies is 20.3%, with a reward to risk ratio of 5 to 1. I think those are pretty typical. Often in a well-diversified portfolio of small, mid-sized, and large company stocks, we might see average projected earnings growth of closer to 11%, and then the dividends will make up a little of the extra return, and we also will capture some return from buying and holding stocks at lower PE ratios, and that gives us a total return boost, and that's how we get to 20.3%. Assuming that all companies will work out, we don't expect that every stock selection that we present in the newsletter will perform according to our expectations, but our goal is that 4 out of 5 of the stocks that we cover will perform as well or better than we expect. 1 out of 5 will perform exceptionally well, and that will help offset the losses for those companies that end up disappointing us. So I think that all in all, we're in good shape as we look at the current coverage list, and certainly after the December issue came out just before Thanksgiving, we've seen a lot of subsequent deterioration in the broader market. So values of many stocks have fallen in the last couple of weeks. As of that publication of the December issue, there were a number of companies that I identified as having very good prospects at valuations not seen in several years. So I think there is a lot of I have a lot of optimism about many of the companies that we're tracking. We'll talk about those as well. Despite market volatilities, we continue to focus on the long term. There's certainly a lot of headwinds and tailwinds to balance out, but I think the tailwinds will help drive many of our selections to higher performance levels over the next few years than we've seen in the peak of the bull market cycle. So we're talking about the what's ahead for stocks in the economy. Of course, we don't have a crystal ball. There's not a lot of predicting that we like to do, but we can certainly provide some framework for looking forward. And my focus is on the year 2024, which is 5 years down the road. By the start of that year, where will the economy and the markets be? And I think no matter how you slice and dice it, I think there will be, if we do have a bear market and a recession, we will see recovery by that time. And so we focus on that next peak going forward. And what happens in the valley in between here and now, and what we'll see by 2024 is for other people to worry about. For the newsletter, newspaper writers, magazine writers, and the talking heads on television will make a lot of hay from the material that they're given with what's going on in the current state of the market. But we're not so worried about it. And as I said, I think there's a lot of optimism, reasons for optimism as we look forward. If the bears are right, here's a simulation of what one possible scenario would be, I think, in a worst case mode. This is a long-term graph of the actual performance of the S&P from 1880 to 2018 in blue, and I've marked the 1929 crash and the 2001 bear market and the 2008-2009 bear market on the graph. Now this is a semi-logarithmic graph, so it's showing us the rate of change as opposed to the actual values of the index as it was reconstituted going back to 1880. And on the right side in red is a what-if scenario if we replayed the 2008 and 2009 bear market from this point, again, driven by the financial crisis and the recession that the company dipped into. It was a pretty steep drop that we saw in 2008 and 2009. And to put it into perspective, as you look at this graph, you can see that sudden decline hadn't been really matched until you get back to 1929, although it didn't last as long and it wasn't as severe. But a lot of people throwing around numbers as opposed to percentages. And the semi-log graph, when you look at it this way, we focus on sort of the percentage gain and loss of the overall index. But let me zoom in and show you if we look at what I would see as a worst case scenario if we go replay what happened in 2008, 2009, and the market does take another nosedive and a subsequent recovery. Where would we be? And if that were to happen by 2024, we would be up just about 25% from the current levels, which is not bad. It may be below the goals that some people have for long-term performance. But by 2030, we see the recovery with the S&P well above 5,000 from where it is right now at 2,600, 2,680. So it seems while it might be disappointing to some investors over the longer term, we would see that constant bullish direction of the market taking us right back to high levels, and this correction kind of shaking out some of the noise. And again, if the S&P only gained 25% over the next 5 years in total, we would have opportunities to eke out higher rates of return by taking advantage as the market dips down, and the lowering tide lowers all ships, and that would give us opportunities to find some stocks that would deliver higher rates of return. So as I said, I think this is a worst case scenario. I don't think all the forces are in place to give us a bear market of this particular level, but it's hard to make any kind of prognostication. And of course, there is probably a very good chance that the current volatility in the market will continue for a couple of months at this point. And the market is definitely kind of changing up things from the upward direction it's been taking in the last couple of years. So I thought I would talk a little bit about how you might face tougher markets, if they're sideways markets or if we do go into a full-blown bear, and provide some tips. So I've pulled together 6 suggestions. And the first is to remember the laws of supply and demand that do impact the market. Stock valuations are really driven by supply and demand, although over the long term, earnings are going to drive those valuations. But in bull and bear markets, there are a lot of factors like interest rates and economic indicators, what's going on with those. There's no question that interest rates are going to continue to creep up. My take is that the increases are going to be managed by the Fed slowly enough that they're not going to have a negative impact on company growth, and people who need capital, businesses that need capital, aren't going to be priced out of the market for some time. Mortgages are not going to reach the point where they become unaffordable for people who are looking at starter homes. That's going to take time as well. So I don't really see interest rates as having the growth of interest rates having a real big impact on business. And I also don't think that interest rates are going to go up fast enough to pull people out of the stock market on a wholesale level. When interest rates are so low, when you can get 1% in a savings account, people will drive assets over towards equities. And that will reverse at some point, but I think we're still some time away. Economic indicators have been mixed for quite a long time, in my view. The recovery that's been going on since the end of the recession in 2009 has been piecemeal. It comes in spurts and starts, and we see a lot of positive signals like unemployment falling very low, but we also see negative signs like wage growth doesn't follow as strongly as we would expect. We see weakness in the automobile market as tastes have changed and companies aren't responding rapidly enough and are forced to take drastic measures, but yet we see consumer confidence relatively high. And so we just go on and on and on. There's always for every argument that the economy is strong, there's a counter argument that something is weaker than it should be. And so that uncertainty, I think, has helped stave off some of the excesses of the market. Market sentiment surely plays a role in valuing equities, and right now the market is uncertain about the future, and so it's behaving accordingly. Fundamentals of individual companies and fundamentals of businesses and industries are always going to drive the market eventually in many cases, but in the short term, fears about fundamental performance of particular industries and particular companies will always drive the market. And certainly fear tends to drive way too much of market behavior. I think that many investors just don't understand the market, think that they can play the market as opposed to implementing a strategy that will ensure longer-term success. And that sense of fear and the sense of the bigger market players, the investment banks and brokers, manipulating that fear for their own benefit, throws some turmoil into the market as well. So we're going to continue to see demand for equities in the short term, I think, but yields and rates are going up, and so some investors might make the decision to move out of stocks, and if they do that on a large level, that's going to continue to drive the bear market and make it a self-fulfilling prophecy. Number two, the short term doesn't dictate the long term. In the short term, especially, drivers of the market are often not very rational whatsoever. But in the long term, earnings growth is always going to win out. And the long-term companies that are successfully building their businesses and making profits are going to see their stocks prices go up. And again, eventually, sometimes we have to be patient while that happens. But bull markets are also not rational in that they drive prices into overvaluation territory. And so that has been a factor in stock selection in our Small Cap Informer newsletter and in the Investor Advisory Service newsletter in the past 2, 3, 4 years, where it's become harder and harder to find bargains in the market. We find plenty of well-managed businesses, but their prices are at high levels. Sometimes it's difficult to make that decision to recommend those companies. But in the end, they're the best opportunities we have, and so we rally the forces and get behind them. Occasional corrections can be very healthy to kind of shake out those excesses. And so right now we're in the midst of a shaking out period. And the only question is, how long will it continue, or will it worsen? But number three, we look at market sell-offs as opportunities. As prices fall, a lot of investors are going to panic, and that's going to create the bear market and create even more favorable valuations for many businesses. So as stocks fall into fair valuation territory, we're looking at those as opportunities for longer-term success. Remember, we buy the stocks. We're not buying the market. If the market is down, it doesn't mean that every single company will be down. And take a look, if you're not convinced, take a look at days when the S&P 500 is down 2%. Not every stock that we follow will be down 2%. Some will be down 4%, and some will be up 3 or 4%. So there are always opportunities to invest when you are a stock picker. You don't have to worry about the overall market so much. Number four, bear markets always end. I think a lot of the media play around a bear market is how terrible they are and how they go on forever and ever and ever and ever. And that's really not the case. If you look at the data, the average bear market lasts 10 months. And typically, the average bear market comes every 3.4 years. The fact that we're into year 8, year 9 of the current bull market is another reason that the bears like to point to, that we're due for a bear market. But there's a lot of factors that come into play. I always think it's good to be prepared for the downside, but don't be driven to irrational action because of a fear of the downside. Volatility is normal, and we evolve lots of different strategies to cope with it. Some people tend not to look at their brokerage statement or their 401k statement during a bear market and just wait for things to start recovering before they start looking at things again. And there's a lot to be said for this laissez-faire, hands-off approach to managing a long-term portfolio if you're susceptible to taking action out of a sense of, I have to do something, when holding as a strategy can be very successful if you hold through periods of down valuation in the market. Number five, we can use the current volatility of the market to our advantage, especially now at year end. This is a great time to do some portfolio cleanup, to sell stocks that have gone down in value, to capture the capital losses. You can use those capital losses to offset any realized gains that you might have had in the year, or you can lighten up on some positions where you've got some stocks that have performed very well for you. Maybe you've got some long-term capital gains that you are afraid to incur. If you have some losses now, you can balance out, and that might help with portfolio diversification as well. There's certainly the prospect that the current correction will continue into a bear market. If you do have stocks that are at that high end evaluation range, you might be thinking about some strategies to protect them with stops or trailing stop loss orders. If the market continues to trend down, you might be able to exit before the very bottom, well before the very bottom, with a soundly implemented trailing stop loss, and that might help with protecting some of your gains if you're concerned about that. Deploying available cash can also be a strategy to improve your expected return. We don't advocate sitting on cash or using cash as part of an asset allocation strategy, but if you've got cash that's sitting there that you haven't been able to find a use for, you haven't been able to find optimal investment candidates to invest in, well, you're going to have plenty of opportunities in the next couple of months, in my view. And then finally, if you are holding expensive companies relative to their past, I think it's time to think about lightening up, especially on those. Maybe you've already felt the pinch as those gains have evaporated out of your portfolio. You can always revisit those companies if the prices continue to go down. And again, portfolio management is dynamic, and so we're not second guessing the decisions we make. We know that there are always opportunities to be found in the market, and so we'll try to find the best opportunities at any point in time. And number 6, let's focus on the coming good times. As I mentioned, any sustained bear market or recession will likely have ended by 2024. So let's think about the new highs that our market and economy will reach, and don't be dissuaded from a sound investing strategy by normal market behavior. Corrections in bear markets are normal market behavior. And Terry makes a good point in the comments that markets can be flat for many years. So I mentioned a sideways market. We could have a market where valuations remain static. They don't drive up for the overall market, and that could go on for quite a long period if investors become disappointed in the prospects of the equity market. I don't think that that's quite as likely that we'll have a sustained sideways market, but we could have a period of a couple of months, 6 months, 9 months, a couple of quarters worth for sure of this sort of uncertainty in the market, driving a lot of not very exciting movements one way or the other. And again, from our perspective as stock pickers, that gives us the advantage of finding opportunities where others are afraid to go. So I wanted to update you on the performance of the SmallCap Informer stock selections. And so this is a graph that shows the benchmarked compound annualized rate of return of all of the picks, both the ones currently in the newsletter and any stocks that have been discontinued, compared to in yellow, the Russell 2000, and in pink, the S&P SmallCap 600. Many market watchers will point to the S&P SmallCap 600 as being a truer small cap index than the Russell 2000. But the S&P SmallCap 600 has not performed very well in the last couple of years, while the Russell has done a little bit better. So I commonly use the Russell 2000 as the benchmark to compare, but I thought I would throw up the S&P SmallCap 600 to give you a little sense of how that smaller segment of the market has performed. The Russell 2000 includes companies that are a little bit larger than the average size of the companies in the S&P SmallCap 600. Year to date, the SmallCap Informer picks are up 3.5%. Doesn't sound like much, but that's quite a bit better than the 3% rate of return of the Russell 2000. Again, this is a benchmarked basis, so we're not looking at the starting value and the ending value, but we're replicating the cash flows as if we bought every stock an equal amount of stock in every recommendation published in the newsletter. For the year ending December 11th, the SmallCap Performer picks up 24.4% on an annualized basis compared to 13.8% for the Russell 2000. In the 3 years ending 12/11/2018, up 10.6 to 10.4% for the Russell 2000. So still edging out a little bit of outperformance compared to the index, and that's all we hope for. In our manifesto, we espoused a strategy of not swinging for the bleachers, but to simply eke out a better rate of return than the index over time, to hit a lot of singles, get on base a lot, and score that way. So I think we have been successful in that strategy. We'll continue to refine our approach. We've been hurt by, again, our long-term nature, and sometimes we sit on companies as the valuations decline without a formal strategy of implementing stops and recommending stops, although I do cover in many of our updates, especially for companies that are a little more volatile, I do discuss protecting those positions with stops as we expect the volatility to drive the price downward until the fundamentals kind of kick in and lift the price back up again. So that's where we stand in terms of our performance. If you have questions, just a reminder, go ahead and use those. And let's talk about some of the other positive things that have happened nationally, the recognition that the newsletter has been getting and our stock picks. You may have seen our SmallCap Performer picks featured on various outlets, including The Street, Forbes, Investopedia, themoneyshow.com, and at presentations like the virtualinvestorconferences.com, where we talk about the newsletter and our stock approach. And so those have been great, important recognition for us. The Money Show, where we have been participating. We're participating in their expanded schedule in 2019, where they're adding Philadelphia and Seattle to the list. And so I present there, and we exhibit in the booth with Better Investing. At the beginning of 2018, they published their top stock picks report, the best stock fund and ETF ideas for the coming year. There were 100 stocks that were nominated by financial advisors and newsletter editors who participate in the Money Show. And one of our picks was a top 5 pick for the year. It was Emergent Biosolutions, the ticker EBS. So with a 43% gain, was pretty solid stock pick in a pretty abysmal year for many equities. And so we're very pleased that that stock performed well for the year. If you recall, Emergent Biosolutions was introduced in our November 2017 issue at $43.85. It is a biotech firm. It's focused on biodefense, so vaccines and treatments for anthrax and Ebola and some other pretty difficult to treat diseases for which there's not a huge market, but very serious conditions. One of their big contracts is with the U.S. military and the federal government, providing vaccines for servicemen. They're continuing to expand by acquisition as well as from their own research. And so here's the graph of the company. Performance on a fundamental basis, sales, profits, and earnings going back in time. So you can see that upward trajectory there. It's not a phenomenal growth stock, but only $560 million, but doing important business. Here is the performance of the stock, on the other hand, on a percentage basis compared to the Russell 2000 and the S&P 500. And so you can see the stock, since we recommended it until it was closed out in the December issue, was up 61%, while the Russell 2000 was down 2.8%, and the S&P 500 was down a quarter of a percent during that same period. So that's a pretty strong performance from that single company. So we're glad to have made that list. If you remember from the December issue, it was $69, so we had about a 59% total gain if you had bought it the day after publication and sold it the day after the sale issue was published. I think the growth expectations are still good for the company. I like the business that they're in. However, by the end of November, the projected relative value was 157%, and the reward to risk ratio was 0.7 to 1. Anytime you see relative value above 150%, that's an indication of a excessively high value. The P/E ratio is just simply too high and not sustainable. And the reward to risk ratio, when it's below 1 to 1, is also a warning sign. So from my view, as the market was already coming down from the highs in August and September, it's just too much downside for this stock. And that's why we decided to close out that position in the December issue. We might pick it up again as we continue to monitor it. If the price were to come down, it might be a great opportunity to get back into it. But I'm pleased with that, the performance of that particular company, and especially the timing of it with the Money Show's top stock picks report. So those are just great acknowledgement, I think, that our approach can work during difficult markets. So let's talk now. I mentioned earlier that in the preparation of the December issue, I identified a number of stocks that I thought were especially attractive. And as I looked at management's updates and their quarterly earnings, I saw a lot of positive news, a lot of certainty that management was presenting about their upcoming performance. And so as the stock prices of these stocks were coming down, I just think that these are really interesting opportunities. And so I wanted to call out those stocks right now. As we look ahead into a more volatile market, I'll talk about some of the risks as well as some of the upside of these 8 or so companies on my list. Note that cheap stocks can always get cheaper, and in the last 2 weeks, many of these stocks have dropped in price another $1 or $2. In my view, that's just helping them to become more attractively valued. So do your own research before these stocks. Some of these are going to be very familiar names to you as we go through them. Here's the summary. I'm going to go through them one by one and talk about these companies and why I like them. This is Air Lease, no surprise. We've recommended Air Lease 3 times in the newsletter. It's one of the oldest stocks that we have been following since the newsletter was founded. I like Air Lease as a business. They buy airplanes and they lease them to airlines. It's very easy to understand. Global air travel is growing at 5 or 6% a year, so that's fueling demand for planes. And airlines are seeing the benefit of more modern planes that have features built into them, like entertainment systems or Wi-Fi, as well as oversized luggage compartments to keep bags out of underneath planes, and that are also more fuel efficient. So airlines are really looking, after many decades of neglect, at upgrading their fleet with newer planes, and so that feeds into Air Lease's business. What we also like about the business is that we know we have a lot of visibility into their order book. So they have a fixed amount of capital, of course, that they can buy these planes from Airbus and Boeing, and we know, looking through their order book, that 96% of their order book is filled for 2018 2018 or for 2019, and 82% is placed through 2020. So we have a very good sense of how much they're going to be earning in leasing revenue over the course of these long-term leases. When airlines have gone out of business, Air Lease has been able to reposition those planes very quickly, and so there's really not a big gap in the leases once they are set up by Air Lease. Some people are concerned that as interest rates go up, that's going to increase Air Lease's cost of capital. But Air Lease has interest rate risers on all of their lease agreements. So as interest rates go up, the lease payments go up. And so that protects them on that side. Air Lease has actually been reducing their cost of capital because they're able to borrow globally. They're able to make debt offerings to the public or to investors, and that provides capital. So all in all, things are still going strong for Air Lease. I think it's a misunderstood business. I think a lot of investors don't understand how their cost of capital is managed. And then finally, as we look at Air Lease, it's a diversified business, 94 airlines they do business with in 56 countries. So that's going to help them beyond the economic cycles that happen in the U.S. And will keep them operating on a sound basis as we continue to move forward. Finally, their partnerships they're setting up to bring in capital. So the partners put in capital. The partnership buys the plane, and Air Lease manages the partnership and manages the leases. So they take a management fee. So none of their capital is at risk, but yet this is a source of robust fee income for them to manage those partnerships. So all in all, I think that moderate growth at Air Lease, I'm looking for 14% or so. It will translate into a pretty substantial rate of return. Now, financial stocks, especially, will have lower PE ratios. So we're seeing that PE ratio contract, but the price is just not moving in line with the fundamental performance, and over the longer term, that's going to resolve in favor of shareholders. So I'm still very optimistic about Air Lease. ASGN used to be On Assignment. They renamed the business. It's one of the larger companies we follow with $2.6 billion in sales for fiscal 2017. They had 3 very strong quarters coming into it, and in their third quarter earnings release, management was very optimistic about both the commercial and government clients they do business with. On Assignment, or ASGN as they're known now, is an employment services company, but they're not a temporary workforce solution so much as a placer of contract employees for IT work, computer programming, healthcare, graphic design. So highly skilled workers who don't wish perhaps to be in the full-time workforce or want to be remote employees or remote contractors. Maybe they don't want to work the full year. And so this component of what's known as the gig economy, this is fueling Airbnb and Uber and Lyft, rideshare businesses where people are using other resources to make a living as opposed to a 9-to-5 job, are fueling the growth of ASGN. They have some units outside the U.S., so that provides a little bit of protection against what will happen during a recession. And as the unemployment rate ticks down, that fuels the need for many companies to hire. If they can't hire, maybe they can contract through ASGN. So it's been a good performer for us, and I think it's going to continue to perform quite well. And I have it as a buy up to about $77. So I think there's plenty of opportunity to look at this particular company. Century Communities is the home building stock that we've been following for some time. Century Communities is one of the top 10 biggest home builders in the country. They made an acquisition earlier this year that expanded their presence in the Southeast U.S. So they've got a geographic proximity to a lot of areas of the country that have strong fundamental drivers of those local economies. So that's working as well. They also they've got a financial services group that provides mortgage, title services and insurance. So that continues to expand, tripled its profits year over year. Their business is starter homes, and this is very separate from the luxury home market that many of the top home building companies service. So companies like Toll Brothers are in a completely different market, and the market for luxury homes has slowed down. But Century Communities sells starter homes. They build communities and build homes that sell for around $280,000, $260,000, $280,000, and those selling prices have been ticking up, which again is good news. The Bay Area is one of their strongest divisions in the West, and they build homes that the millennials who are starting families and moving out of the urban areas are looking for, with options for solar and alternative energy sources. They're of course the communities are hardwired for ultra-fast internet access, so you can stream and play games and watch Netflix, which is what people want out of new homes. They have all the amenities that people are looking for. So it continues to be good. The bear case for Century Communities is that home building is very sensitive to the economy, and if we do enter a recession, companies like Century Communities or LGI Homes that we also cover are going to perform poorly. But you can see this company is at its 52-week low, even though it's delivered 3 or more quarters of successive record growth for the company and its markets. At $1.4 billion in sales, it's not an enormous company compared to many of the luxury peers. I think when you look at home ownership stats, we haven't yet reached the pre-2007 levels. So there's still a lot of opportunity for the company, in my view. And then finally, they own enough property to get them through 2020 at this point. They've been buying land. They've been using capital to make those purchases, and they've been also optioning land. So they put money down, they lock it in for a period, and then when they're ready to move ahead, they can finalize the sale. So that precursor of buying land, they've been managing that as well. Management has reiterated their guidance for the full year to continue to be strong. So I think there's opportunities here. And again, if we do have a recession, we will see a slowdown. But over the longer term, I think Century Communities is going to continue to grow. Related to Century Communities, in participating with home building and home ownership trends in the country, is Essent Financial. Essent is a provider of private mortgage insurance, PMI. So it's going to have a lower valuation on a PE level because of its business as an insurance financial services business. But they, again, $1.4 billion. $576 million for Essent Financial revenues in the last fiscal year. 3 very strong quarters. One headwind they faced was that their biggest competitor announced that it was going to be taking its corporate tax savings from the tax reform and use it to lower premiums. So Essent was forced to lower its premiums along with every other provider of PMI in the country. But if you look at Essent's margins, they are terrifically high. The company is very adept at using technology to keep prices down, so they're able to take market share from their bigger competitors in the expanding first-time home buyers market, where PMI is the need for PMI is the strongest. And so again, the price, when it takes a tumble, I think, again, it would be a good long-term opportunity. I think in the short term, again, I keep reiterating on it, but I want you to be to understand that if we enter a recession, a company like Essent is gonna see its insurance in force go down probably, and that will drive the price down. But it's already at a very low level as investors are acting on irrational fears, I think. But I think it's a very attractive at its current price. Evercore, rather new to our coverage list, $1.7 billion in revenue. This is an independent asset management investment banking business, and so they had a strong quarter in the third quarter. But it was impacted by lower than expected closings on some of the banking deals that it had expected to make. The company thinks that some of those were just pushed into the fourth quarter, which will help provide a firm basis for that. The Institutional Investor Magazine's All-America Equity Research Team rankings included Evercore for the fifth consecutive year. They were number 2 on a weighted basis, number 4 overall, and the top independent research firm in those rankings. So they have a great reputation. They're a small but growing business. And management says they have a great deal backlog. They continue to recruit investment bankers, which is key to their business. So that helps expand their team and makes it possible for them to continue to deliver. The current PE at 19 at the time of the December issue publication was near a 52-week low. So projected PE based on visibility into next year is around 16. So again, just a great opportunity, I think, to invest in the financial services industry, where we don't often get a whole lot of opportunities to invest as growth investors. FleetCor Technology is a company that kind of spans industries, and I like that as well. They're a financial services company, but they're also in the transportation industry. That's their business, is providing payment solutions, payment cards for trucking fleets and truck drivers. And so they have been able to build out a business delivering those types of payment cards, which provide ease for management to track spending of their drivers, and also for the drivers to be reimbursed after they've incurred the costs of lodging and fuel and other costs while they're on the road. So earnings have been going pretty well. The third quarter was hampered a little bit by a business that they divested. A little bit a benefit came from a business that they sold. Gave a little bit of a benefit, but there was an accounting change that helped cause that little bit of a downturn you see on the graph there. But the organic revenue growth for the quarter was 11%. So that's just very solid. $2.2 billion in revenue for last year. Strong double-digit growth in corporate payments, tolls, and lodging categories. So they have been just performing quite well. Transportation is an essential need, moving goods around the country, and so this fits into that. One good note is they had arranged with McDonald's to provide acceptance of the FleetCor cards. So that, again, very positive, we would expect as well. And just icing on the cake, in the third quarter, management raised their guidance for the fourth quarter. So again, management is saying, it was a great quarter, but we expect the year to be better than we thought. So we're letting you know now. So in the face of all of the fears about the economy turning down, FleetCor is saying, nope, not yet. We're not seeing it. In fact, we expect things to be even better as we go forward. So again, those kinds of indications are are hard to ignore when companies are come right out and say, yeah, things are better than we expected. That is a really solid sign for individual investors. We started covering Ollie's bargain outlet in the December issue. Price had come down a little bit. Earnings had come up. It was still pretty pricey on an adjusted PE basis, but I decided that it really was the type of company that I wanted to cover. Revenues just $1 billion. Ollie's is a bargains outlet store chain headquartered in Harrisburg, Pennsylvania. They have been building out. I think they're about 280 to 300 stores now. They see the potential for 900 stores around the country. Now they're largely in the East Coast and the South, distribution centers in Pennsylvania and Georgia, I believe. What's great about this company, this is a retail discount store. It's a defensive stock. Ollie's is sort of treasure hunt shopping because you never know what you'll find in the stores. They stock housewares, they stock food, automotive supplies, they stock flooring and hardware, they stock books, electronics, they stock toys, clothing, and shampoo, soaps, things like that. You never know exactly what you're going to find because they make acquisitions from other businesses that are going out of business. They will buy, if you're a drugstore, department store chain, and you close down a store, Ollie's will come in and take all of the inventory. When Toys R Us shut down earlier this year, Ollie's went on the TV and said, we'll buy everything. We'll take everything. We'll send the trucks to the distribution center right now, and we'll take all of the unsold inventory of Toys R Us. They pay pennies on the dollar, and they're able to reprice it at a favorable price, and customers take advantage of it. They have a great shoppers reward program, and those people who use the shopping rewards make more in purchases per visit than people who don't. So they've got a loyal following. After the publication of the December issue, Ollie's has come down on, after their third quarter was, results were published, they issued a little bit of a revised downward guidance, and the market didn't especially like that for the rest of the year, second half of the year, or the last quarter of the year, essentially. And so the price has come down quite a bit. Now to around 60. It was 80, I think it was around 88, 89 when we published the issue, and now they're down to about $69. So that's a pretty significant drop off, but I think it makes Ollie's one of the best bargains in the market, if you will. I like Ollie's for many of the same reasons that we selected Five Below. Five Below has just been a phenomenal performer for us. Five Below is a chain of discount stores where every item is $5 or less. They target teens, tweens, kids, and their parents, where your dollar goes very far because there's all sorts of options for products and gizmos. Fidget spinners were a big seller when they were trendy last year, and what Ollie's and Five Below can offer, and I think the same could be said for Duluth Trading, that we also cover, is that the experiences of shopping there can't be replicated by e-commerce or Amazon in general. So those types of companies, I think, in the bricks and mortar space have a big moat around them that e-commerce isn't really able to touch. E-commerce, the companies can't sell enough products under $5, $10 because of the shipping costs and the logistics of packaging, etc. And so I think Ollie's and Five Below, those types of companies will perform well. Ollie's, like Duluth Trading, has a unique shopping atmosphere that's a little more fun. And so I think that also helps make Ollie's distinctive. So I suggest taking a look at Ollie's at this reduced price. I think this is a really a great opportunity to buy into a fast expanding business chain. You probably are familiar with Skyworks Solutions, again, one of the largest companies now in our coverage list, but it wasn't when we started covering them. But they perform very well, revenues at $3.8 billion. With 49% of their business last year was with Apple. And so anytime Apple hits a speed bump with its iPhone sales not up to snuff or projections not as high as the market would like them to be, then Skyworks takes a hit as well. But Skyworks has a lot of strength going for it. It has exceptional margins. It has no debt. It has an expanding product base. They're being hit by Chinese tariffs so that they can't deal with some companies in China. And so that's impacting them. But again, I think in the short-term basis, there's going to be some softness in their markets, but over the longer term, they always seem to manage to eke out the best opportunities possible. If sales go down, they will likely be able to manage their margins and continue to be profitable. And so I think that's pretty positive. The present yield at in the middle of November was 2%. And that, I think, provides a solid floor. The yield doesn't get very much above that. So I think that the current price is probably pretty close to a reasonable floor for the stock. So in the high 60s. I don't think it's going to get much cheaper than that for a very, very strong company there. And then finally, we'll wrap it up with TPI Composites, which we started covering earlier this year. You can see the S&G looks a little messy when you look at the last couple of quarters. But let me tell you what's going on at TPI Composites. This is a company that makes composite blades for wind turbines. So they're making these the very big wind turbine blades that are used to generate energy increasingly here in the U.S. and around the world. The business has been growing pretty well, $930 million in sales last year. Their business model is kind of interesting. They essentially lease out production lines to other manufacturers of the rest of the components of wind blades. So companies like Siemens, a division of Siemens, or General Electric are selling wind blade systems, wind turbine systems, and the installation of them. But TPI Composites has a specialty in these very high tolerance components of the wind turbines made of composites, so they are very strong and very light, very efficient. And so other manufacturers actually turn to TPI Composites and say, you make these, you do it better than we could. And so that gives them a real strength in the marketplace. But it also provides the opportunity for a lot of visibility into future results because they have a set number of production lines. Some of the recent downturn in earnings is because they're ramping up new production lines and in plants in Turkey and Mexico and Iowa, and that's important. I'll talk about that in a minute. They've got Chinese customers, and they've been also taking down lines and transitioning them to make bigger blades. Why bigger blades? Well, bigger blades are actually more efficient. So if they increase the length of the blade, those units become more efficient. So they've been transitioning customers into these larger, more efficient blades. Again, there are very few companies that can make them. So TPI Composites has a real solid lock on the marketplace. So that's going to help them. So we know that they've got GE to transition over on some of those lines. And we also know, as I talked about those plants in Turkey, Mexico, Iowa, they're able to manufacture in locations where they can navigate the uncertainties of global trade that have been causing a lot of havoc for other companies. So they're able to, work in Mexico or Turkey, and they're not having to deal with restrictions on trade with China, for instance. So they've been able to increase their lines under long-term supply agreements. They now have 50 production lines that are on long-term agreements. And so their potential net revenue under contract is now $2.6 billion. You see they made $930 million last year, so they see visibility into more than 2.5 times that revenue in the next 3 years. So once we get all this gets up and running after the next quarter, management has provided guidance about what they expect sales and revenue to be at a baseline for 2018, for 2019, and for 2020. So we see these targets of the company having net sales by 2020 of between $1.7 and $1.9 billion. So essentially, the company is expecting to double in size in 2 fiscal years and on a revenue basis, based on what they've got underway right now. So we think that's pretty substantial. That's going to continue to help drive the stock price out of the current levels. Investors who know understand what's going on, so the price hasn't come down, especially. And when you look at this on the stock selection guide, because of the decline of earnings, it's really hard to fit a projection line that kind of gives it that represents the business at least until we get the next quarter underway. But I'm looking for 2019 earnings of around $1.30. And so based on that, the forward PE is around 19. And that just seems ridiculously cheap for a company of TPI Composites' unique position in the alternative energy field. So those are just some advanced thinking on some of the best opportunities. Certainly, the companies we presented in the last issue, Boot Barn, again, unique shopping experience, Western-themed apparel. People don't go online to shop for cowboy boots and other Western gear. They want to try it on. Boot Barn has been very strong, and I would expect them to be even more reasonably priced right now, in addition to Ollie's. So let me take a couple of your questions, and then we'll wrap it up. Terrence asks about stops. I thought stops were against better investing principles. Better investing doesn't have any particular stance on using stops. Many educators in the better investing community will talk about using stops. Automatic stops are somewhat contentious because they are final and don't require intervention, and so it might be if they're mispriced, if they're misset, and the market does what it does, which is maybe it falls 5 or 6% in a week, and the next week it's back up. And so selling out of that market might not have been the best move that you could have made. If you want to get back into the stock now, you have to buy in at a higher price, and so that can be expensive and not doesn't help your long-term portfolio health and return picture. But on the other hand, I know a lot of educators who do talk about using trailing stop losses, especially on companies for which you have a lot of unrealized gains, or that you perceive to be more volatile than the average stock. And certainly the companies that we're tracking in our SmallCap Informer, being smaller businesses, being less widely known on Wall Street, having less institutional interest, they can be susceptible to a lot of factors that throw their price around. And so I think that the prudent use of stops can be healthy in many of those cases. What's the next question is, what's the appropriate level for a trailing stop loss? And that's really problematic, somewhere between 5 and 8%, I would say. Looking at the downside prices of many of the stocks that we follow, The downside seems very far away from the present price because we're in a bull market, and yet those downside prices we're trying to capture a correction or bear market price. We might not want to test that low price, and so you can also use a mental stop if you don't believe in automatic stops. And I just caution people for especially higher PE companies in our coverage list that to be to be mindful of the volatility and your stomach for it. If you can take it, then yes, holding through periods of volatility can be an effective risk management strategy, even though buy and hold gets a bad rap from the rest of the marketplace. But you might explore ways of employing some stop orders in your portfolio if you're concerned about particular companies or about the direction of the market. Bob asks if I ever look at the AAI shadow stocks for ideas. We were at the AAI conference in Las Vegas in November, and I'm familiar with shadow stocks, but I haven't actually reviewed them currently for some time, so it's not a source of information. Every once in a while someone asks me and I think, oh, maybe I should take a look, but it's not on my list. Typically, we're looking for stocks using our My Stock Prospector screening tool, and so I have a watch list of about 100 companies that I've identified as possible candidates. And then I winnow through those, and we whittle them down to, six or 8 or 10 that rise to the top over time, and then we track those companies. All these I've been looking at for a year or two, waiting for the opportunity to get in. And of course, the minute we decide to pull the trigger and say yes, take a look at all these, it declines 20% in the next 2 weeks. So hopefully, subscribers were a little lazy, didn't act right away because of Thanksgiving, and now have the opportunity to buy the stock at that lower price. And I'm tempted to include it in the next issue as one of our best ideas for long-term return at a reasonable valuation right now. Well, I want to thank you all for coming to our webinar. I hope that our SmallCap Informer newsletter has been useful to you in finding ideas for your portfolio, and look forward to many more years of serving as your editor. And please feel free to email me with any questions at gerlach@iclub.com, and we'll look forward to catching up with you again in the middle of next year. We'll do a mid-year review, but as well, you can find information about our other webinars on the iClub.com website. Each on the second Monday of the month, we have our lunchtime stock club, where we often talk about stocks that are featured in the SmallCap Informer, and our other newsletter, the Investor Advisory Service. So that might be interesting to you. You can find those archived on iClub.com or on YouTube. Once again, I thank you. I wish you the best for the upcoming holidays and all the best for 2019. It has all the markings of being another interesting year for investors, and I hope that it's a positive one for you. Thanks again.